Good afternoon. It's my great pleasure to be here to support our friends from Financial Nigeria and the Nigerian Development and Finance Forum in this conference. I'd like to begin by making just a short personal remark on my own, just as the chairman of our session did. And I think it's good to do that because it puts things in perspective. I spent, like most of you here, I was educated abroad in the United States, where I took my master's at the Fletcher School of Law and Diplomacy, and here at LSE, where I took my doctorate. And I spent 17 years in the United Nations, at duty stations in 4 continents, doing different things: legal work, strategic planning, management, and so on. And after a while I left. I got in to be a director in the UN, and I felt I had hit some kind of glass ceiling. What was left for me to be was to become either an Assistant Secretary General or an Under-Secretary General. And I served as an Under-Secretary General for 6 months on a special appointment at the request of the Secretary General. But for some personal reasons, I decided the time had come to leave the United Nations. And I set up a consulting firm in Geneva, Switzerland, called Sogato Strategies. And we were offering advice to companies and organizations and governments on global strategy and risk management. And that's what I was doing, enjoying myself thoroughly, making a bit of money for the first time in my life, when I got what at the time, quite frankly, was a disruptive invitation from my perspective to come home to Nigeria to become Deputy Governor of the Central Bank of Nigeria. That invitation came from the President at the time, Umaru Yar'Adua. I was at first reluctant, but on second thought, I said, why not? Although it's disruptive, the timing wasn't what I had expected, what I would have liked, but this sort of historic opportunity sometimes can come only once. And I remember that all the while I was in the UN, I remember what an Indian friend of mine called Shashi Tharoor used to say. And he used to say, India matters to me. I'd like to matter to India. And so I always felt that Nigeria matters greatly to me, and that someday I'd like to matter to Nigeria. And so that call from the President, I felt I now interpreted it in the context of this phrase that I have used. And I decided to take up that invitation. First of all, I was impressed and surprised that positions at that level, that you could be invited without lobbying anyone. I wasn't a member of any political party. And so it was a pleasant surprise. And I took up the opportunity, went back home, got confirmed by the Senate, and started on the job. And I can tell you, like the chairman, I have not one moment's regret. The things I'm going to tell you now, and for me to have been part of that story, to me is an honor that is a once-in-a-lifetime thing. And so I think it's important that we should think seriously about our country, about our place in the world, and what we can do to make Nigeria a destination of greater importance, greater vibrance, and greater economic strength. Nigeria has a very peculiar position because it's the largest country in Africa in terms of population. It's the largest country in the world in terms of the black race. And so there are some worldview issues that are involved regarding Nigeria's development and its possible transformation that should never be lost on us. And what we have done in the Central Bank of Nigeria under the leadership of Governor Sanusi Lamido Sanusi is to have demonstrated a lot of things that were lost on people in this country, in Europe, and in some other parts of the world. I will tell you how we resolve the banking crisis and the lessons that it holds that other countries and other continents can learn from. So let's go back to 2008. Of course, we all know that the global financial crisis had had a great impact by that time already. But one of the things that the global financial crisis revealed was the importance of a phrase that is now commonly called financial stability. The stability of the financial system, the stability of the banking system, not just the stability of individual banks, which was the more traditional approach with regulation of banks. It was compliance-based, it was not risk-based. And people went to individual banks, looked at their books, and found out if they were complying with all the things they needed to comply with. But what the global financial crisis taught us is that the risk and the systemic dimensions of finance are hugely important, because if it touches one, it can touch all. Not necessarily by what you've done, but because of what others have done. And therefore a systemic approach to the regulation of the banking system is extremely important. And so we saw the limitations of the traditional micro-prudential approach to supervision in addressing system-wide stress, and the failure to understand the interrelationships between the financial sector and development in the broader economy. So I'll talk about three things. I'll talk about the crisis, how we intervened, how we stabilized the banking system, and set in place a chain of reforms. And I will talk about it from the perspective of macro-prudential regulation and supervision as opposed to micro-prudential regulation and supervision. And then how that links into the real economy, because that's what it's all about at the end of the day. So everybody knows that the Nigerian economy was negatively impacted by the financial crisis through a number of channels. And the most important of those channels was the decline in oil revenues. Nigeria is a monoproduct economy. Oil accounts for 80% of Nigeria's revenues and about 90% of its export base. And that's just not a good thing at all. It sets you up automatically in a major way for huge systemic risks that are caused by developments in the global economy, such as what we're seeing again now in Europe. The recession in Europe, the slow recovery of the United States economy, the soft landing of the emerging powers such as China and India. All those things again are raising in our minds in the central bank some very important questions about what we must do going forward to shield Nigeria to the extent possible from these shocks. Some countries were not affected very heavily. The banking systems of certain countries were not affected very heavily by the global financial crisis. And there is a reason for that, and we'll talk about that. So a lot of banks in Nigeria in the run-up to the crisis were overexposed to two sectors. One, they were overexposed to the oil sector because of the overdependence in oil. The prices in the oil were very high, and when that is the case, Nigerian banks are awash with capital. That's what happens. And so they were, and combined with the consolidation of the banking system, which took place between 2004 and 2006, when 90 banks were collapsed into 25 banks, a very necessary step to make those banks stronger, for them to have buffers, for them to have more capital. The capital was taken up from 2 billion naira to 25 billion naira. And so the whole idea was if you couldn't raise it, you merge, or you get out of the way. That's what happened. Now, but what also happened is that, the banks began to lend a lot more. They have more capital to lend, but that lending wasn't going where it should have been going. The reason was because the real economy did not have the capacity to absorb that amount of lending. And so a lot of lending went into the oil and gas sector and into the capital market, capital margin loans. The stock market was booming like there was no tomorrow. People thought that stock prices only went one way, and that was up. That they couldn't understand. The investors were not sophisticated enough to understand that the stock market can sometimes crash. So banks were lending like there was no tomorrow to people who wanted to buy shares, and these two things created huge systemic risks to the banking system. As at the end of December 2008, Nigerian banks' total exposure to the oil industry stood at 754 billion naira, and that represented 10% of total banking industry credit and 27% of shareholders' funds. At the same time, the exposure of the banks to the capital market stood at 900 billion naira as at the end of 2008. And that represented 12% of aggregate credit of the industry and or 31.9% of shareholders' funds. Clearly, this was an accident waiting to happen. And so, when the oil prices crashed, when there was depressed demand ability from the developed economies and investors, Nigeria's stock market had about 60% of its value held by institutional foreign investors. And of course there was a flight to safety, and they pulled out their money. When they pulled out their money, the stock market crashed. When the stock market crashed, the loans that were given to buy shares went bad. The loans, when the price of oil crashed and the Nigerian banks did not have the type of capital that and liquidity that they used to have, again, they began to have problems. So non-performing loans piled up hugely. And about 8, or let's say 10, of the 24 banks were assessed as being in grave danger of survival. And so around this same time, Governor Lamido Sanusi was appointed as the governor of the central bank. And the central bank conducted a stress test of all the banks in Nigeria and came to this conclusion that 10 banks were not stable. They were in fragile condition, and if some serious intervention was not undertaken, those banks would have failed. And if they had failed, the remaining 14 banks, which were so-called safe, would have also suffered, because there would have been contagion, there would have been a loss of confidence in the banking system, and depositors would have lost their money. So the central bank intervened, moved into these banks. At least for 8 of them, what they decided to do was to sack the management. 8 bank CEOs were sacked. 5 of them were sacked in one day, and the other 3 were sacked later. And the reason the governor believed he had to do what he did was to create room for new management in these banks, because there were serious problems of corporate governance, serious problems of serious absence of risk management, and many of these banks were headed by CEOs who were also significant owners of the banks. And that's why their interest in maintaining control, the central bank felt that if you allow them to maintain control, the central bank would not be able to undertake the reforms it felt it needed to achieve in the Nigerian banking industry. And so there was a feeling that those CEOs had to be moved out. So that was the first action. And then the central bank injected about $4 billion, that was about 620 billion naira, in liquidity support to make those 8 banks going concerns. So this was the original intervention. That now set the stage for the reforms that now came. And those reforms have 4 pillars, and we're still executing them today. Reform is not an event, it's a process. It's not an end in itself, it's a journey. And those reforms are 4. First of all, to enhance the quality of Nigerian banks. That involved massive changes in the corporate governance framework of banks, changes in risk management standards, the introduction of more transparency and disclosure and accountability in the banking system, and so on. More integrity, data integrity. Those were all things that were part of the first leg of the reform program to enhance the quality of banks. The second leg of the reform program was to ensure financial stability. What was going to happen to all these huge 2 trillion naira in non-performing assets, non-performing loans? The injection that the central bank made in the 8 banks was only a temporary thing, just to provide them with liquidity support. It could not solve their problems on a long-term basis. So, those non-performing assets, something had to happen.
they had to be taken off the balance sheets of those banks for those banks to become stable banks going forward. So addressing that problem was the second item of the reform program, which we called ensuring financial stability. The major avenue through which that was done was the establishment of what we call the Asset Management Corporation of Nigeria, AMCON. That's called a bad bank. In other countries that have had banking crises in the past, they used this method, created a bad bank that bought off those bad negative assets and cleaned up the balance sheets of the banks, packed those negative assets somewhere, restructured them or did whatever with them, and I'll talk about that in a little while. The third leg of the reform program was to facilitate the creation of a healthy and efficient financial system. That meant two major things. First of all, the structure of Nigeria's banking industry needed to change. We used to have what we call universal banks. A bank could have a banking business, a bank could have an insurance business, it could have asset management, stockbroker, pensions, all sorts of things. It was a financial supermarket. Now, this obtains in continental Europe, but they have managed it better. The problem it had for us in Nigeria was that the ability to manage and supervise this complex structure of subsidiaries over which the Central Bank of Nigeria, which is the regulator of the banks, does not have control. The central bank does not regulate insurance, the central bank doesn't regulate pensions, the central bank doesn't regulate stockbroking, and so you have banks having these as subsidiaries, but the main regulator did not have access to those subsidiaries. And the regulatory institutions in Nigeria at that time were not mature enough, and the regulatory coordination was also not mature enough to be able to have some sort of consolidated regulation of these disparate entities. And so, in some of the banks, these subsidiaries were used as avenues through which a lot of smoke and mirrors games were played. Depositors' funds were put at huge risks and used for speculative trading in the stock market, stockbroking loans, and so on and so forth. And at the end of the day, people were in very large danger of losing their money. So that's the third part of the reform, to create an efficient financial system. Another dimension of that, so this dimension of the universal nature of the banks had to be addressed. So what the central bank did was to abolish universal banking. What we did was to say to banks, you split off non-core banking assets so that we ring-fence depositors' funds and they cannot be used for speculative activity. And that has been done, and it's still being done because we give them a timeline. The second dimension of that third leg of the reform was to create a more efficient payments system. There's a huge emphasis on cash in Nigeria, and it's very expensive. The central bank and the banks spend about more than $1 billion every year just managing cash, creating it, printing it, transporting it, safeguarding it, and so on. And so we felt there was need for a much more efficient payment system that was more electronic. And of course we know that there were security issues, a lot of armed robbery, people stop you on the way and want your cash. So the hope is that the cash light environment that we're encouraging through electronic payment systems will help also to address this issue, in addition to, of course, being a much more efficient way of transmitting payment transactions. So the fourth part of the reforms was what we called to ensure that banks contribute to the real economy. And that's perhaps the most important part of the reform program. And that links into the link between banking stability and economic transformation in Nigeria. So we've set up AMCON. AMCON has done very well. They have purchased all those non-performing assets, and the bank's balance sheets are healthy today. Those banks have resumed lending. They are not bogged down by the bad loans that used to be the case. AMCON in Nigeria, we have brought a lot of innovation
to the resolution of banking crisis. But the most important thing I should note is that while we did all these things in crisis mode, the time has come to build much more permanent structures going forward, so that in the future we have a system that can respond proactively through macroprudential supervision, looking at systemic risks, looking at the linkages between the financial industry and the broader economy, and to see how those risks wash into the banks or vice versa, and addressing those risks in time before they crystallize. Now, in the case of Nigeria, what we did with the Asset Management Corporation was to make it an institution with 3 mandates. First was to buy all the non-performing loans of the banks. The second was to play a large role in the recapitalization of those banks. So we've had some quite massive M&As, mergers and acquisitions, that have gone on in the banking industry over the last 18 months. And that has led to about 20 banks now being in place instead of 24. And some of the banks did not merge, but there were strategic investors that recapitalized those banks, working together with AMCON. So AMCON bought off the non-performing loans, helped to recapitalize the banks, and has the mandate to act as a debt restructuring vehicle. In no other country of the world where they have used a bad bank have you seen this combination of responsibilities in one institution. In Malaysia, they had it in different institutions. There were about 2 or 3 institutions that did all these things. In Nigeria, we put it all in one place. And that made it much more easy to direct and much more efficient to operate. So this is one lesson that the Nigerian banking crisis resolution offers for other countries. Another important lesson is that, and I should point out, let us not forget, in the whole of the Nigerian banking crisis, no bank failed. We did not allow any bank to fail because the central bank guaranteed all depositors' funds. They issued a guarantee for the interbank market and guaranteed creditors. That's a huge exposure. But we had to do it to make sure that we maintained confidence in the banking system, because if confidence failed and there was a run on the banks, the economy itself would collapse. The assets of Nigerian banks today, 19 trillion. That's a lot of money. So that's one very important thing. The second thing, so no bank failed in Nigeria, unlike in many other countries. Secondly, we have resolved the Nigerian banking crisis without a penny from the treasury. In many countries, such as here, Northern Rock was nationalized, and so many other banks. In the United States, about 1,000 banks failed, smaller banks, yes, but still huge bank failures. But in Nigeria, how have we done this without the treasury putting in its money? The reason is simple. AMCON is financing the purchase of non-performing assets by issuing bonds. Those bonds are backed up by a guarantee of the federal government, but we have no intention of allowing those guarantees to crystallize, or those obligations to crystallize. And how have we made sure, or tried to make sure, that that obligation does not crystallize? We have set up what we call a sinking fund, in which all the banks in Nigeria contribute 0.3% of their annual assets for the next 10 to 15 years to pay for the cost of the resolution. And the central bank itself is contributing 50 billion naira every year. So this is the structure that we have tried to work out to help, and that's in case AMCON's recoveries are not enough to pay for those bonds. So these are some very innovative things that we've done, which have been done in no other place in the world. Not in America, not in the United Kingdom, not in Germany. In Denmark, they put their former prime minister on trial